A margin account has more features than a cash account, and they're used by more active or experienced investors. A key difference between a cash account and a margin account is that with a margin, you can borrow funds to buy investments, whereas with a cash, you must pay for all purchases by the settlement date. And because of this, a margin account is an account you'll apply to and be approved for, just like a loan or any other type of credit. Think of a margin account like a home equity line of credit, or a HELOC. Homeowners who have a HELOC use the value of their home as collateral or leverage to give them a line of credit. They can then use that line of credit for whatever they like home renovations or a trip. Typically, a HELOC will allow you to borrow up to 65% of the market value of a home. With a margin account, investors use their investments as collateral. If they go to buy stock, they would pay up to at least 30% of the cost, and the broker would lend the remaining 70%, depending on the value of the investment they're looking to buy. Like a HELOC, the investor must pay interest on the loan. Also, it's important to note that using a margin is completely optional. You can have a margin account and never end up using any margin if you choose to pay for all of your investments with your own money. The choice is completely up to you. Let's look at how borrowing would work. If you intend to buy $5,000 of a stock that has a margin rate of 30%, you could put down as little as $1,500 plus commissions and borrow up to $3,500. This is called leverage. Leverage may amplify the returns you make on your money invested. On the other hand, it could also amplify your losses. For example, if you use $1,500 of your own cash to buy $1,500 of stock, you'll make 5% on your investment if the stock moves up 5%. In this case, that would be $75. But if you bought $5,000 worth of stock with $1,500 of your own cash and the stock moves up 5%, what happens? The $5,000 invested is now worth $5,250. This means you've made $250 on your cash investment of $1,500. This would be a return of 16.6% on your capital before deducting any amount paid for interest. The opposite would be true if the stock went down 5%. This is where the similarities between a margin account and a HELOC end. They differ when it comes to how often the loan amount changes in value. With a HELOC, if the value of your house goes up or down, the value of the house used for the loan tends to be less frequently reassessed. With a margin account, your investments are always changing in value, so the amount you can borrow can change daily, at a minimum. You should know that the amount you can borrow on margin is not unlimited. In fact, there are maximum caps you can borrow for specific investments. For example, a stock with a 30% margin rate has a $1.5 million maximum loan value. This means that the most TD Direct Investing can lend is $1.5 million. This is the equivalent of buying $2.14 million of stock and receiving a loan of $1.5 million at 70%. This is probably a scenario that few will run into, but there are stocks that could have smaller limits. For example, stocks with a 75% margin requirement and a 25% loan value can only have a loan value of $100,000. If what you buy costs more than the maximum loan value, you can. You just have to cover the outstanding cost with your own cash that's sitting in the account. The maximum cap amount that a broker will lend you is called concentration guidelines, and you can read more about that and other margin requirement details on our website. Any available margin you have is called margin excess. This usually means you have more borrowing funds available against your current investments that you can put towards buying more investments. But if your available margin excess drops down and it's in the red, you're in something called a margin call. If this happens, you need to deposit funds into your account or liquidate some investments to bring your margin back into green. Waiting too long might impact the ability for you to continue to hold your investments. Many investors who use most of their available margin will monitor their accounts closely to try and prevent falling into a margin call. If you're tempted to use all or most of your available margin, think about if you're providing yourself with enough room to allow your account to fluctuate in value. For example, if you use all your margin to buy stocks today, and over the next 3 days those investments go down 10%, you'll be in a margin call. You'll need to either sell at a loss or deposit funds to cover that shortfall. If you had left some buffer room to allow your portfolio to fluctuate, you may not have fallen into the margin call. We'll go over this in more detail in our margin calculations video. You can now see how a margin account is different than a cash account. Another key difference is that more advanced trading strategies and investment types are available with a margin account, whereas a cash account has some limitations. For example, a margin account lets you trade options and short sell. These are strategies we'll explore in other videos. Now that you understand how a margin account works, we'll delve a little deeper. In our next video, we learn how to do simple margin calculations so you're ready to take on your first margin trade.